physical market. They tend to be, they probably feel it makes more sense for them from a revenue perspective to offer ETFs or gold mining shares, where their commission structures are a bit more aggressive than they would be on a physical gold transaction in an IRA. But that is really the choice of the trustee. It's not a matter that they can't do it. It's a matter they choose not to do it.
So other options other than buying GLD, which is an example of a proxy for the price of gold, and we talked a little bit about the physical gold, although I have a few follow-up questions on that. You could also buy stocks of companies that are gold miners. Some of the more popular names are Barrick Gold, Newmont Mining. You probably know many more off the top of your head. But what are the pros and cons of doing that instead of GLD, kind of the more passive approach?
Well, I think there's when you're talking about gold mining shares, there is more leverage, and there's obviously, because of more leverage, more risk. So not only are you investing in the gold mining company, you're investing in basically the management of the company. You're investing in their gold reserves, their cost of production. So it takes a bit more work to come up with a valuation that is reasonable, so that you can make an investment decision to determine which of the gold mining companies offer the best risk-reward from an investment perspective. Now, most people, when they buy gold mining shares, tend to get enamored with the junior gold miners. And, really, in my opinion, on a junior gold mining basis, you may get lucky, but quite frankly, I think your odds are better at a casino than making money on juniors. Because the problem with a junior, unless they've got a good history of management and they've got some proven track record, is you've got somebody or a junior company that's come out, they've hired a geologist who always tends to be old and gruffy, and says, look, we think gold reserves or proven gold reserves in the ground of X number of ounces or X number of grams per ton. And then they go out and they raise seed capital, and everybody gets excited. From the point of that guy telling you that they've got X number of grams per ton in the ground to it actually coming out of the ground is a huge and long process and costs a lot of money. So, these juniors tend to refinance a number of times, which creates obviously a problem for your stock positions. And what they do is sometimes they'll come to market and actually produce. So to me, it's a gamble. You're going to buy 10, 9 are probably going to go to 0, and 1 you might get a home run on. So it really is, in my opinion, I consider that more speculative than an investment. Now, if you look at the majors, like a Barrick or a Newmont, they're not necessarily great either. It really depends on where the gold price is going, their cost of production. So again, it's a company that you need to analyze their balance sheet, the same way you would analyze a balance sheet of any equity sitting in, on the exchanges. What I tend to like, if I'm getting into that type of an investment in the precious metals arena, is I like the streamers and the royalty companies. And there I like Franco-Nevada. The management there, I've actually known for almost 40 years. I mean, they're top-notch managers. And Wheaton Gold. These people own royalty rights in hundreds of mines. Okay. They have no overhead. They just get a piece of the action of everything comes out of the ground. So I think they are a better proxy for the price of gold when it moves up or down than even the seniors are in most circumstances.
All right, great. So the another option is the physical gold, and we did talk about owning the physical gold, holding it at a custodian, such that would be required for an IRA. But what about an instance where you want to own physical gold, it's not in a retirement account, and you want to physically keep the gold yourself? First off, how common is that, and how do you feel about that as part of what we talked about earlier, a diversified investment portfolio. Can you touch on that for me?
Yeah, well, you're still going to get the diversification because you're holding gold. Now, the downside of holding physical gold and not holding it from a custodial perspective somewhere is you're going to receive the gold, and it's a very common transaction. I would tend to think about 30 to 40% of the physical transactions that occur in especially in the U.S. market, are ones where the client is actually taking physical delivery of the metal to their home. And so now then you've got potentially storage issues, potentially risk issues if you get robbed. I mean, gold is not covered under your blanket insurance coverage of your home insurance. It's treated more like jewelry. You need to get a specific insurance for it in case you are worried about somebody taking your gold from you. The other downside of buying physical gold as opposed to investing in, say, an ETF, assuming you have a comfort level with an ETF, and there's a percentage of investors that just do not trust the system. They don't trust that the gold is there backing the ETF. They don't trust the miners because they've been burnt over the past 5 years with mismanagement, and they want to hold the physical gold. Now, in that context, it's going to be more expensive because holding physical gold, other than the fact of worrying about storing and insuring it and possibly paying shipping charges depending on the dealer that you engage with, is you pay what's called a premium to the gold price, which is in industry terms called a fabrication charge. And the rule of thumb is the smaller the gold bar, the more expensive the fabrication charge relative to the gold price. So to give you an example, if gold was trading, we'll just use round numbers, at $1,300 an ounce, and you bought a 1 ounce gold bar, again, depending on the dealer, you'll pay a premium of anywhere from $20 to $30 over the gold price for that 1 ounce of gold.
So is it fair to say, because I have, for example, a very dear friend of mine, I would categorize him, and I mean this playfully, I love him, is he's a doom and gloomer. He does not trust the financial system. At every turn, every headline, and this has gone on for a number of years now, he thinks this is it, this is the big one, and he wants to own physical gold because if there is a crisis, an emergency, some breakdown in order or in the economic financial system of the country, let alone the world, that owning gold would be a good idea. I don't think we need to comment too much on that thought process, although feel free to do so. My question, though, is if we assume that did happen, I'm not convinced that owning gold would be particularly helpful in that outcome anyway. I don't know if owning gold bars in my basement safe would necessarily be helpful in that instance. Do you agree with that assessment?
I do, again, it's a delicate subject because investors that buy gold, don't necessarily buy it from the perspective of an investment. They buy it from a perspective of emotion.
Right.
I'm not saying all do, but some do.
No, that's fair.
And when you, I just look at sort of the dynamics of what would happen if the entire global fiat system collapsed and the banks no longer existed, there was no financial medium to do a transaction. So in that context, I would consider that pretty much Armageddon. I mean,
sure.
There would be absolutely mass riots, anarchy, the whole supply chain would basically collapse under that system. So here I am, I've got my gold bars in my basement. First of all, there's no market that I can sell these gold bars at, so I go to my neighbor and I say, look, I need some gasoline or I need some food. I highly doubt my neighbor's going to take a 1 ounce gold bar to give me gasoline. Okay. I mean, he's likely to want something tangible that he can use that he may not have, I don't know, a generator, whatever.
Sure.
In that context, I disagree with the conclusion. The other thing that I have an issue with that mindset is that some of these investors believe that the U.S. government is going to ban gold ownership and make it illegal to own gold, which, in all fairness, has happened in the history of the United States government.
Sure.
But the irony of it is that they buy their. When I ask these individuals, where do you buy your gold, they give me a name of a U.S. dealer.
Yes.
And I say, that makes no sense, because the first place the government is going to go to find out who owns the gold is to the U.S. dealers and get their records, and then they'll know that you bought the gold from them. So if that is your concern, you might want to consider buying your gold outside of the United States, either from a Canadian or a European or even a Far East dealer. But then again, your storage of that gold wouldn't be in your home; it would be outside of your country, which I think is what you would want to have happen. If you think your country is going to implode, you would want some of your assets outside of your country. So that would be something to consider if that's your mindset.
No, that's good, and I appreciate that it is a delicate subject. There are many investors, including those in gold, that have significant worries, and they're acting on that. I'm not trying to diminish it. It just seems like, and I don't know the exact phrase you used on it, is some of their conclusions on how to protect themselves, at least to me, don't seem particularly well thought out enough. But what I wanted to ask you about, and I teed this up earlier, and it's been a great discussion so far, thanks again for joining me, is what's your short-term outlook for gold, and then maybe we could talk a little bit about out further what your outlook is. But in the short term, what are you thinking?
Well, we were... Again, when I do my blogs or my commentaries, my orientation is towards individuals that are traders, not individuals that hold precious metals from the perspective of a allocation into their portfolio as just sort of a balanced portfolio. So, from a trader's perspective, I'm very sensitive to the financial news that comes out on a daily basis, and unfortunately, as a trader, I could be bullish at 9 o'clock and bearish at 9:15.
Yeah.
But we suggested back in September of last year. I mean, I'll just give you a little history. That gold had made a bottom in August, and we suggested aggressively getting into the market. We then suggested again prior to the Fed rate meeting in December that gold should be bought ahead of the meeting. We anticipated that the Fed would raise rates one more time in December, and probably not raise rates in 2019. And we still hold that thought process. In that context, we were very bullish gold until about 4 weeks ago when gold hit 1350-ish. There we suggested to get out of the trade and just watch to see if gold could break up through 1365, which is a critical resistance level, and until it did, to stay out of the market. Now, we watched this market come all the way back down, and we re-entered the market just at the beginning of this week, actually, at 1282. And we were anticipating that the U.S. dollar would start to weaken probably sometime mid to late spring, and that would be the catalyst to move gold prices higher. We still believe that is in the cards. In the short term, however, we need, from a trader's perspective now, we need gold to hold that 1278 level. And as long as it holds 1278, we remain constructive both in the short and medium term.
Okay.
Longer term, again, you have to define what longer term is. But as a trader, I can't go past sort of a 1 week, sort of 72-hour type of scenario,
right.
Because again, I'm in and out of the market.
Sure.
But from a perspective of an investor that has not got a gold weighting in their portfolio, and they don't want to sort of jump in at one price, I mean, there is another way to approach the gold market, and that is dollar cost averaging. So if you want to build up a 10% weighting or a 5% weighting of your portfolio in gold, you figure out what that number is, and maybe once a month, you come in and you buy a percentage of that.